Today, we're going to review the Phoenix real estate market for the first half of 2026. And if you're expecting a crash like some have speculated, you may want to stick around and see what really happened. Do we even dare talk about affordability? All the market information out there says we're in a buyer's market. Some believe this means prices are falling significantly, even catastrophically. The only problem is it's not connected to reality. So let's get into the details. Here's a chart of the Cromford Market Index for the last 25 years. A balanced market at 100 means that prices will increase at the rate of inflation. Supply and demand are in equilibrium, and neither buyers nor sellers have an advantage. Above 100 means it favors sellers, and less than 100 means buyers have the advantage. What's interesting is the Phoenix market historically has favored sellers, although we all remember what started in 2008, a crash caused by loose lending standards, subprime mortgages, excessive credit, and speculative buying. More recently, it was skewed the other way when it was a seller's market on steroids. Low supply and low interest rates sent prices skyward. Now this next chart shows what's behind the market index, the interaction between supply and demand. So let's look at each. What you'll notice is the supply or listings have had more volatility than demand, and the area in between the two help us identify buyer and seller markets. So where are we right now? The Cromford Market Index is at 81 for the overall Phoenix number. Definitely in buyer territory, but it's a very broad brush. You'll notice the gap between the demand index and the supply index, confirming it's a buyer's market with supply running higher than demand for the broader Phoenix real estate market. However, the index covers almost 30 cities and 2 counties, so not every city has the same score. Some lean towards seller market territory in varying degrees, and some are strongly in buyer market territory, depending on the supply and demand. Let's take a look at some cities and see their market supply and demand indices, and why you can't paint each city with the overall Phoenix number. For example, Fountain Hills is definitely in the seller market category. Why? The demand is relatively normal, but the supply index shows a constrained supply of homes for sale. This pushes the market index upward to seller market territory. Now, we're seeing the same dynamic for Chandler, but a little less demand. In the more balanced territory, look at Sun City West. Supply and demand indices are both below normal, but equally so it's a balanced market. Where are those buyer markets? Maricopa shows less than normal demand and above normal supply. In addition, there's an abundant supply of new homes. The market index indicates a strong buyer's market. Buckeye has a normal demand but above normal supply, pushing it into buyer territory. Queen Creek shows a similar pattern, close to below normal demand and high inventory, so a low market index. All of these cities also have strong supply of new homes not accounted for in these numbers. Let's look at the overall listing trend in 2026 and compare this to previous years. Compared to last year at this time, listings are down 6%, but still above 2023 and 24 levels. This chart reinforces one of the key themes of today's market. Supply is the most volatile part of the equation, and it's often the factor that has the greatest influence on where prices are heading. To demonstrate this, let's pick the city of Phoenix. In 2008, when foreclosures and short sales were more common than they should have been, the city of Phoenix had over 11,000 listings. Fast forward to 2021 and 2022, there were many months where the listings were less than 1,000. That's crazy and shows how volatile listings can be. Now I better move on to prices before you lose interest. Prices are something that we are all interested in and contribute to affordability. We need to look at single-family homes and condos separately, and you'll see why. Here's the graph showing the quarterly sales price for single-family homes. The quarterly sales price takes out the noise of the month-to-month number. Prices remained flat for the last 3 months of the year and 1% higher than at the end of the year. Remember, each city is different and will have a different number. Flat home prices are good for affordability when you have inflation going on around you, unless you're a seller. Okay, now I'm moving on to condos. I've separated condos because they have their own dynamic. Due to an oversupply of apartment building in recent years, rents are going down. Those would-be condo buyers have less motivation to look at a condo instead of renting. Condos hit their lowest median sales price for the second quarter of 2026 since the first quarter of 2023. A win for affordability on both sides, apartment renting and condo buying. Another component in the affordability equation is how much of a buyer's income can be dedicated to a mortgage payment. I came across this graph that provides some insight. The St. Louis Federal Reserve shows that the personal disposable income has been rising. Over the past year, it has risen 3.8%. Now, this may seem insufficient to many, and if your income hasn't risen, you may even question this graph. But if it's true, we're moving in the right direction. Buyers markets are not all about price. Here's another metric to consider. Offers that come in requesting seller concessions to assist with buyer closing costs or rate buy-downs are much more common than 3 or 4 years ago. Currently, seller concessions are part of over half of the transactions, and they can also be used to address issues found during the inspection. A plus for affordability that's often overlooked. You probably think I'm cherry-picking the affordability-friendly metrics, but interest rates are in the other camp. Interest rates have risen in the first 6 months of the year, rising from 6.2% at the beginning of the year to 6.6% at the end of June 2026 on a conventional mortgage. Not a help towards affordability. At times, buyers or sellers may feel that they are running into the wind rather than having it at their backs. So what has been the net effect? Have home sales fallen off a cliff, or is the market just telling a different story? Let's look at the numbers. Despite all the discussion about higher mortgage rates, affordability challenges, and a buyer's market, more homes have sold, not fewer. First half sales rose from 35,562 in 2024 to 36,238 in 2025 and to 37,670 in 2026. That's a 3.9% increase over last year. So if somebody says nothing is selling, the data really tells a different story. Homes are selling, they're just selling in a more buyer-friendly market where buyers have more choices and negotiate more than they did a few years ago. The overall Phoenix real estate market favors buyers, but this does not mean that there is a crash. Prices are stable, which is encouraging when we feel that inflation is all too common in our daily lives. And if you're considering buying a condo, the good news is the price has dropped, the lowest in 3 years. Listings are a major driver in the real estate market, and in fact are lower now than this time last year, but higher than the 2 previous years. Buyers benefit that seller concessions are more common than ever, and sales for the first half of 2026 are higher than 2025. Personal disposable income has increased. Unfortunately, interest rates are still a major deterrent to affordability. And if you want more detailed analysis regarding a city or possibly a property, please reach out to me at 480-326-8571. Thank you.